This video will be a quick guide to explain to you in a very simplistic way market structure and breaker structure. So with that being said, let's get started. So what is market structure? So the market, usually the main three structures are, you would see an uptrend, price moving to the upside. You would also see price ranging around the same area, and you could also see it on a downtrend. So you've got here an uptrend, you've got ranging market, and you've got a downtrend. So what identifies an uptrend? This is when price breaks the highs. So it creates higher highs and higher lows, higher highs and higher lows, higher highs and higher lows. And with the downside, it creates lower highs and lower lows, lower highs and lower lows, lower highs and lower lows. So with this in mind, whenever you see price, if you are on an uptrend or on a downtrend, okay, so let me go back one step. Talking about an uptrend, whenever you see price always breaking the most recent high, this is an indication that potentially it will continue to the upside. Now, when price breaks this first high, keeps on going up, it creates another high, but you wouldn't know that this is a new high until price pulls down and it creates a higher low. How do we know that this is a higher low? Because price did not break this previous low, right? And so it keeps on going again, price goes up, breaks this high, it creates a new high, so on and so forth. Likewise, as well, with the downtrend. So price will be going in this direction, for example. Oops, apologies. I think I deleted it. So price will always be breaking the lows. And this is the indication for us that price is going to the downside. So you see here, it broke this low, right? When it broke this low, it kept on going. It created another low, but how do we know that this is the new low? Well, it retraced again. It created a higher low. It came back and it broke this lower low again, right? Again, this is an indication that price is continuously going down. With a ranging market, what you would tend to see is price just creating highs and lows, highs and lows, highs and lows, highs and lows within the same range. This is the same range for price. So ideally, depending on the strategy that you're using, it's always best to trade when price is either going to the upside or when price is going to the downside, when it's trending, right? So we always want a trending market. And this is very important because with a trending market, there is volatility and there is a clear direction for the market. Now, I wish if price would actually move, as simple as that. But in reality, price does not move in this way. So let's talk about a bullish trend, for example. So as I was saying, it would look something like this. We've got the highs, lows, so on and so forth. So on the higher time frame, you would see it looking like that. But once you go into the lower time frame, you would see price creating, let me just choose a different color. You will see price creating within this, creating higher highs and higher lows. It will be going something like this, really. So you might be thinking that price is on a downtrend when you see this happening, for example. Okay? But that's what you will see on a lower time frame. And this is where a lot of people get it wrong. They keep on looking at the lower on the lower time frame, and they get it mixed up. They see price creating lower highs and lower lows, lower highs and lower lows on the lower time frame, and they think that the trend is going down. And so what we should always look at is the higher time frame. This is where you would look at the bigger picture. So why is this important? The bigger picture will give us an indication of the high probability setups that we're looking for. So on the bigger picture, if we are seeing the price is actually going up, that means we will only be looking for buy setups. So if at any point of time we see price doing something like this here, right, we will not enter the market. Again, here, these are just like big pullbacks. They seem on the higher time frame, but on the lower time frame, they would trick you into thinking that the trend is actually going down, which is not the case. So what I would do is wait for price to come down into these areas of lows, and then look at pure price action at points where I could potentially go for a long position. So this is in a nutshell, right? So let's just elaborate a little bit more on break of structure. Now I'm still going to be using the bullish example, but as I said, it can always work in any bullish or bearish. It's just the opposite, basically. So what is a break of structure? Again, price is creating something like this. This is an uptrend, and we are looking at the higher time frame, and price is creating higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. So when price retraces down and pushes up again, and it breaks the previous higher high here, this is what's known a break of structure. It broke the previous high. As I said, this is an indication that price could potentially keep on going to the upside. Now, when you see that there is a retracement and price is starting to move down, what you've got to do is wait for a setup. Now, what do I mean by a setup? Now, obviously, it depends on the strategy that you're using. But for argument's sake, let's talk about just pure price action. No indicators at all or anything like that. So what you'll see, so this is on the high time frame. Let's now look at the exact same thing. Yeah, let's look at what's happening here on the lower time frame. So we can see the price is continuously going down, correct? So when price is going down, it's breaking the previous lows. And this is how we know that it's still going down. So all we've got to do is wait for price to show us signs that it's actually reversing to go to the upside. So what happens from this point, you'll see price going up, taking out the previous high here. So when it takes this previous high, this is an indication that now the trend is changing, i.e. that now most likely price is starting to go in the direction of the trend. This is one point. However, sometimes you will get fake outs, so you have to be very careful. So what price can do sometimes is, let's say it's going down, it goes, breaks this high, but then it comes again going to the downside. So this is obviously a fake break of structure. No, sorry, not break of structure. Fake out, or this is a stop hunt as well. This is how it's known. So how do we actually avoid this situation? The best scenario to avoid it is by waiting for another break of structure. So when you've got two breaks of structure to the upside, this is an indication that potentially price is going to go to the upside. And this is when you want to enter. And this is how you buy the lows. You buy low, and of course you sell high. So how do you identify your entry? So for argument's sake, if you see that the second break of structure happening here, you're going to wait for a retracement before entering. And usually you would find that this area would be an area of support or resistance. So it used to be support, resistance here, resistance in this area here below it, and now it's becoming here support. So again, you look here for price action and you enter. If you are using the order block strategy, now what you'll see is, because we have a break of structure in this area here, we've got an OB forming here. This is a bullish OB. So when do we enter? We wait for price to come down all the way here, touching the OB in this area, then we enter for a buy with the direction of the trend, right? So this is as simple as I possibly managed to explain this to you guys. If you like this video, please make sure that you smash the like button and subscribe to the channel, and comment below what sort of content do you want me to share with you guys, just to help you out with all this free information. With that being said, I look forward to seeing you in the next video. Take care and goodbye now.